Hello, everyone. Welcome. We're just going to wait a minute or so for everyone to get into the room. Welcome, everybody. We're just going to wait a minute for people to come into the room. Okay. Hello, everyone. Welcome to Riding the Wave, M&A Outlook for Business Owners and Sellers in 2026. We're happy to have you with us today. Before I introduce our speakers, a few quick housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to a recording as well as the slides and other helpful content. The webinar will run for 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. Now, I'd like to introduce our speakers. Jeff Box is a partner in LSL's tax and advisory department. His clients, which include privately held businesses ranging from manufacturers and distributors, professional service providers, and high net worth individuals, rely on his advice and assistance on a broad range of financial issues beyond tax compliance. He routinely provides solutions including business and multi-generational tax forecasting and planning, merger and acquisition guidance, and retirement planning. Dora Lanza is a co-founder of Plethora Businesses. Since 1985, she has been working with business owners as well as institutional and private investors. As as the operations manager for Plethora Businesses, Dora works with business owners and deal makers in assessing the value of privately held companies, structuring and financing the complexities of business transactions. She has been awarded the highly coveted designations of Merger and Acquisition Master Intermediary by the M&A Source and Certified Business Intermediary by the International Business Brokers Association. Christopher Aragon is an associate at Plethora and is responsible for analyzing financial statements, building operational models, as well as assisting with industry and market research. He's a graduate from California State University Fullerton with a BA in Business Analytics. He is licensed with the DRE and is currently in pursuit of FINRA Series 69 and 79 63 and 79 licenses. And now I'll hand it over to our speakers.
All right. Thank you very much for joining us. So to start off, let's review how the M&A market fared this year. As the title of this webinar referenced, there were definitely some waves made this year. We started the year with a lot of optimism due to the new administration coming into office, but that quickly subsided with the introduction of large-scale tariffs. Confidence quickly gave way to uncertainty, which greatly affected the M&A ecosystem. This is clearly shown with the data on the right. While the chart on the right only shows data through the first 3 quarters of this year, you can clearly see that there was a sharp downturn in deal volume. Interestingly enough, while there is a steep drop-off in deal volume, deal value managed to hold on.
Mhm.
For that reason, 2025 has been tentatively dubbed the year of the mega deals, which are deals valued at over $1 billion. Another reason for deal values being maintained is the multiple rate cuts that the Fed has made at the back end of this year. This has freed up some additional capital, which has allowed financial buyers to spend more money on acquisitions. Looking ahead to next year, we will be getting a new chairman of the Fed around May, who may continue to cut rates, but we will have to wait and see who's elected. We will also have to wait to see if inflation numbers hold steady or go back on the rise due to these recent cuts. Now let's move on to a more detailed look at deal flow for 2025. So here's a more detailed quarterly breakdown for deals valued under 500 million. The dark blue bars represent deal count, while the orange line shows EBITDA multiples. For those of you not versed in financial acronyms, EBITDA is earning before interest, taxes, depreciation, and amortization. This is a common metric used today when coming up with the value of a business. It's often used as a proxy for cash flows. Most offers nowadays come in the form of a multiple of EBITDA. So, quickly looking at the chart, you can see a consistent drop in deal count from quarter to quarter in 2025. But as mentioned in the previous slide, tariffs played a large part in creating uncertainty in the market, which in turn drove down deal volume. That being said, we did manage to see a rebound in EBITDA multiples in Q3 of this year. One of the reasons for this was the forecasted rate cuts by the Fed that would end up happening in September, October, and just yesterday. We also know from personal experience that financial buyers, such as private equity groups, were being pickier on the deals they were submitting offers on. This, in turn, caused them to be willing to submit higher offers to ensure they got the company that they were targeting. With no new news on any potential trade deals with China, Mexico, or Canada, we believe deal volume to stay around their current levels with Q3 as we close out this year. So up next, we will look at a heat map for deals across the US. This graphic displays the geographic distribution of private equity capital spent over the last 12 months for both platform and add-on investments. Not surprising, the big three, California, Texas, and New York, lead the pack for investments for both platform and add-on investments. A few key reasons for this is the scale of their populations and the level of business consolidation that is still possible in those areas. Going into a bit more detail, California ended up being the leader in activity for manufacturing and technology sectors. But we are also continuing to see a steady increase in capital investments in Texas across manufacturing, healthcare, and especially technology. Not to be overlooked, Florida, Illinois, and Georgia also had strong gains this year and have the potential to be a new hotbed of activity in the years to come as demographics shift. Moving forward, we still expect the big three to continue their reign, barring a massive shift in the market. Now let's transition over to some data on what sectors saw the most activity so far this year. So here's a breakdown of M&A activity by industry. As you can see from the chart, the heavy hitters in 2024 remain dominant in 2025. Out of all the deals completed in 2025, business to business or B2B represented the highest percentage of deals completed so far. The performance of B2B deals in M&A this year are due to some mega deals, including CD&R's acquisition of Sealed Air for over $10 billion. Plethora continues to see financial buyers target B2B businesses, especially around second-tier manufacturing for aerospace and defense suppliers. The other giant in the room is the IT technology sector. While it only captured 18% of deal volume so far this year, it's responsible for 23% of the total deal value. Within the IT tech sector, recurring revenue is a vital metric that buyers continue to look for in new acquisitions. And while software as a service continues to be king, AI is now at the forefront of technology investments and acquisitions. That being said, while a certain industry may not top the charts, there are compensating factors that may drive buyer interest in those sectors depending on their strategies next year. I'm now going to pass it over to Dora, who will go over some buyer trends for this year.
Thank you, Chris. Well, okay, if we look at this particular chart, we see that private equity represents 35% of all completed deals. That is not a temporary spike because over the past decade, private equity's share of the market has grown steadily. What used to be 1 in 5 deals is now more than 1/3. This reflects both the maturity of the asset class and the sophistication of private equity deal making, even in volatile markets. Private equity buyers invest across all deal sizes, from Main Street to large caps, and the smallest funds are getting more active. So if we look at the chart, we see that in 2025, we had 18,570, and Chris, feel free to jump in and help me translate the numbers on that slide, but it represents 35% of deals. The first generation private equity funds, the younger groups, were created by operators of bankers, and they are more flexible on the EBITDA thresholds. Chris mentioned earlier that most of the activity happened in mega deals, but private equity is still investing in deals between 3 and 5 million of EBITDA. Why? Because these first generation PE funds have to build their track records, and that works in the favor of sellers. They have to prove themselves to get into the bigger league deals. So these private equity groups will go downstream and will look at smaller transactions. As an example, a recent transaction that was doing $4 million in EBITDA in manufacturing was acquired by a PE fund that previously focused only on $10 million revenue companies. The rationale, they wanted a strong platform. Even if it was smaller, they saw an opportunity for add-ons. And so this is how private equity group continues to generate revenue. They make an acquisition in a platform and they grow that particular platform by making other smaller acquisitions. So we are also seeing private equity firms form what we call a microbuyout arm, where their whole focus is the smaller companies. Think of groups like Trivest Growth Investment Fund. They focus on the smaller deals. And this is creating the professionalizing of industries that historically lacked institutional buyers. Once a platform's acquired, most PE groups plan on multiple add-ons, as we just discussed, and they will do so by filling product gaps, expanding in geographic areas, and building capabilities. If they didn't have a technology, they'll go out and buy that business that has the technology. If they are lacking in talent, they'll go look for those companies that have the talent. So that is why even niche companies, sometimes too small for strategics, are commanding premium valuations from the PE platforms that are eager to expand. And as we move on to see the actual amount of money in the industry, in our next slide, we see that there is $1.2 trillion of dry powder as we started 2025 versus 3.6 trillion in 2024. So what we're seeing here is just a classic example of the industry cooling, but not slowing. The bars show annual PE transaction volume in billions, and even with interest rates volatility and tighter credit conditions, private equity activity still remained remarkably strong in the 2000s, 20, 21, 22, representing historic peaks driven by post-COVID liquidity and cheap debt and pent-up demand. And what we saw in the last year and in 2025, like Chris mentioned, we were anticipating a major boom in 25, and it didn't happen. It slowed down, but the money still got deployed. So keep in mind that private equity buyers will invest across all deal sizes. And they are deploying capital. They have the funds. They need to deploy it more efficiently. 1.2 trillion isn't a shortage of capital. It is still more money than the industry has ever been able to deploy effectively before COVID. Private equity groups must invest their capital. They have a clock on it. It's use it or lose it. It's not optional money for them. If they don't deploy it within a fixed period of time, it expires. So this creates a structural demand for deals, even when financing conditions are tight. This pressure is what keeps the market stable. Sponsors continue to buy, and strategics continue to prune and reposition. This is why PE has become the backbone of activity during uncertain times. They don't trade when conditions are perfect. They trade because their model requires it. And, consistent with the theme, we're seeing a shift from mega deals to middle market consistency as financing for deals in the 500 million plus became more challenging. Private equity moved downstream. They opted to do more add-ons, and they opted for more independent sponsor activity. In the last 2 years, we saw private equity groups previously focused on those 50 million targets pivoting down. To recap, this decline from 3.6 trillion to 1.2 is not a contraction. It is a recalibration. Trillions didn't just disappear. They simply moved from dry powder to deployed capital into thousands of businesses that are now owned by private equity. And that capital must create returns, and that means more acquisitions ahead. The most influential force in M&A is private equity. Even with dry powder dropping, there is enough deal activity alive and competitive. The message for sellers is simple. Private equity is still buying, and they're buying with intention. So Chris, give us your insight as to the interest rates and how that's impacting deals.
All right. Thank you very much, Dora. Since interest rates play such an important role in M&A activity, we thought it important to provide a little color. The graph to the right shows us the average monthly secured overnight financing rate, or SOFR, along with the volume of M&A activity for the past 3 years in North America. As you may know, these rates have a significant impact on the overall economy, which in turn causes waves in the M&A market. As you can see, in 2021 was the peak of M&A activity due to incredibly low interest rates. It's also why deal flow decreased as interest rates increased and remained high through 2024. Higher interest rates typically make leveraged buyouts more expensive and puts pressure on both deal volume and deal values. Due to their inverse relationship, as rates decline, we typically look to see both deal volume and deal valuation increase. The interesting thing to note is that when you look at the right side of said graph, you will see the SOFR rates drop along with deal volume. This typically inverse relationship has been suspended as they both drop alongside one another this year. Once again, this can be tied to the tariffs introduced at the beginning of the year, which caused mass uncertainty in the market. Buyers are willing to engage in new acquisitions as long as there's some measure of stability with which to provide projections to their investors. Let's quickly jump over to the next slide. This slide is to bring in the previous graph breaking down deal volume under 500 million. We wanted to show you that volume continued to drop even as rates continued to slightly decrease through Q3 of this year. Now we have just had 3 rate cuts here at the end of the year, so we will need to wait and see how this affects Q4. If the rate cuts do not affecting Q4 deal volumes, we do expect them to play a significant role in 2026. To end the section on a positive note, at least, it would appear that there was a rebound in Q3 in deal valuations as rates dropped further. Time will obviously tell us just how big an impact the 3 rate cuts at the end of the year will have on M&A activity in 25. But once again, it's just a wait and see. Next up are some future risks to be on the lookout for when preparing to sell your business.
Thank you, Chris. One of the things that's become prevalent in some of the M&A negotiations, it's this concept of reps and warranties insurance. So what is reps and warranties insurance? It is a policy that's purchased in connection with an M&A transaction. It covers the breaches of seller representations and warranties, allowing buyers to recover losses directly from the insurer instead of the seller. And this is super important because it fundamentally changes the tone of negotiations. Reps and warranties removes the friction, especially in sensitive or founder-led exits. 20 years ago, most sellers carry that full burden of post-closing liability. Today, with reps and warranties, the risk shifts away from the seller and can be cleanly transferred to a third party. So when is the best time to engage in reps and warranties insurance? It's at the letter of intent, not after due diligence. So in our firm, we've been preparing business owners to think about the concept of reps and warranties insurance as a tool in the negotiations. When we are thinking about reps and warranties insurance, we're looking to put that in place upfront before the LOI so that the buyers are more up to negotiating. The ability to set the expectation early does influence the size of escrow and the survival periods. We are seeing on the screen now what it's reps and warranties and the typical limits. It's 10% of company value with a premium of 2% to 3% of limits. So if you have a $15 million transaction, you might see a $1.5 million policy. And that premium is usually around $30,000 to $45,000. The retention is often 0.5% to 2% of the company value. So this is the deductible that must be absorbed before the insurer starts to pay. The coverage scope includes unknown breaches of reps and warranties, the insurer will not cover anything that you already know or should have known. The typical survival period for these policies is 3 years for general reps and 6 years for fundamental reps, such as tax, authority, capitalization. These terms have become standardized enough that sellers and buyers are now walking into negotiations with very clear expectations because it removes the ambiguity and it creates a much cleaner transaction. So, what are some of the exclusions that are not covered? And that includes any known breaches identified during due diligence, any employee or payroll issues, or any retirement plan deficiencies, and any forward-looking statements. Items uncovered but not fully quantified during diligence. The key message here is that reps and warranties insurance protects you from unknowns, not from challenges that show up in diligence. It is not that magic eraser, but it is a shield for honest sellers. Policy sizes are decreasing. What typically used to be only available for deals above 50 million, now we're seeing very commonly used in deals between 10 and 20 million dollars. So although reps and warranties insurance is no longer just for private equity or large buyers, it used to be nearly impossible to get a reps and warranty policy for the smaller deals. Today it's almost expected. So this is a huge win for sellers when they're thinking about a transition. On the subject of reps and warranties, when you're working with legal counsel or when you're CPA, you're looking to make sure that your disclosure schedules are disclosing everything that you should have known and that you knew. And one of the other things that we think it's super important is for business owners to start doing planning early. As we look at the next slide with Chris, he can share with you some of the trends and themes that we're seeing for 2026.
Thank you very much, Dora. So here are some projected trends in store for the M&A market next year. So after the first full year under this new administration, we will be going into the next year with some trepidation. A critical influence on the market will be how the administration handles trade negotiations next year. At the top of the list will be the renegotiation of the USMCA between the United States, Canada, and Mexico, and any potential deal with China. If the Trump administration can get both of those worked out, we should be in a great position for recovery in deal volume for M&A next year. Moving back to AI, while it is still a burgeoning product, it will continue to develop and act as a disruptor in the marketplace across all sectors. Data analytics will also continue to play an important part in the M&A process as buyers' appetites for more data continues to grow alongside their system's ability to quickly onboard and integrate new acquisitions. If you are not actively tracking financial metrics or key performance indicators, you may want to take a serious look into investing in those areas. This is becoming a critical requirement during the diligence and quality of earnings process, where the buyer is looking to comb through all available data to prove the valuation to their investors. Similar to this year, buyers will continue to expend significant energy in the diligence phase, as they look for those diamonds in the rough. The good news is that we expect deal values to increase next year alongside any additional potential rate cuts. And as discussed in a previous slide, strategic buyers will continue to take the lion's share of deals in 2025, but those financial buyers, the private equity groups, will look to rebound with large amounts of deployable dry powder alongside those rate cuts as well.
Mhm.
As Dora had mentioned previously, for them, it's a case of use it or lose it. Private equity groups don't make money unless they deploy their investors' money. And I'm gonna toss it back over to Dora to finish out our portion on the M&A report.
So, what makes a great company great? If you are one of those business owners that are contemplating a process, an exit in the next 3 to 5 years, we want you to look at your supply chains. How resilient are they? It's no longer nice to have, but it's a valuation differentiator. If you have taken the time to diversify your supply chain, you're ahead of the market. Um, the other that we look at is healthy margin profiles. Are you running your businesses thinking about the profit margins? You have to stand out from the competition if you're looking at who is going to be buying you. Do you have a healthy margin profile? Do you have a strong management team in place? Do you have a disciplined growth strategy that's driving your business? Recurring and contract revenue. This one comes up a lot in diligence. What sets you apart? What is the recurring revenue that a buyer coming in to make an offer for your business can reliably rely on to repay that debt that he undertakes when he makes the acquisition? Technology enabled operations. AI is the big talk right now. There's a lot of investments going on in AI. They're not always materializing, but private equity as well as strategic are looking for those companies that have taken the steps to implement technology enabled operations. In the last 3 years, we've seen buyers walk away from great businesses if some of these issues were not in place. Um, Supply chain concentrated in a single country or supplier, no longer a good thing. I mean, COVID taught us that. Companies that diversified early are now commanding valuation premiums. Um, Tariffs was a big driver this year. Those individuals that were able to diversify their supply chain in different geographical locations fared out well because they saw that the impact the tariffs would be having. So all in all, as you're thinking about a sale, think about how to set your company apart from the competition. Concentrate on the principles that drive value in a company. And in that planning, work with your CPA. Reviewed financials carry a lot of weight. Audited financials will get you more dollars in the negotiating table. And with that, I'd like to turn it over to Jeff as he shares with us some of the tax planning preparation that goes into an M&A transaction and how the changes in tax laws are impacting M&A deals.
Thank you, Dora and Chris. That was great information on the current market status of M&A. I was Chris. I thought I heard a question coming up, but maybe not. No, okay. All right. So when we look at tax planning in preparation for M&A transactions, the first thing that comes up, or the first thing that you need to, really look at is how the sale is going to be taxed. We have two areas, two tax rates we need to look at. One is capital gain, the other is ordinary. Capital gain, any part of the sale, or yeah, any part of the sale that would be taxed as a capital gain comes with a preferred tax rate. So that's why it's important to know how much of the sale is going to be taxed at a capital gain and how much of it would be taxed at an ordinary gain. We often will have both of these to consider or to include in the calculation of the total amount of tax that's going to be paid. And depending on how the sale is structured, which we'll go over in a minute, it's going to change how much of it is capital gain and how much of it is ordinary gain. The goal for the seller, obviously, is to pay, as little in tax as you can. With capital gains having a lower tax rate, that is their goal. You want more of the sale to be taxed at a capital gain rate because it's lower than ordinary income. Capital gains, can be 20, 23%. Ordinary can be as high as 37%. So there's a big, swing there. That's why it's important to know how much of your sale is taxed in one bucket or another. The sellers, they, generally prefer to sell the stock or the partnership interest because again, it's taxed at that preferred rate. The buyers, on the other hand, they want to buy the assets of the company. And so when we say the assets of the company, right, that's like all your equipment, everything inside of that company. They're just going to buy it and then put it into their existing company or maybe a new company and, run the business like it has been done in the past. Obviously, a stock or partnership interest sale, they're stepping in into the current company and taking over. So they keep everything there and they're buying the stock and the partnership interest. So when buyers buy the assets, what happens is they purchase the asset and then that asset can be depreciated. And that depreciation deduction is what the buyers want because now they can write off part of their investment that they just made to buy the company. If they buy the stock or the partnership interest for the buyer, they don't recover. When I say they don't recover that money, obviously they make profits from the company they just invested in, but they don't, there's not a mechanism to recover that purchase price. It just sits there on the company's books as equity. There are structuring options if you're early enough in the deal to help reduce the tax liability. Um, and that's what we're going to look at next. So part of the structuring options, the purchase price is a big part of it, but we'll get to that on the next slide. Before you get to that, it's the type of the entity that you currently are in. Are you a partnership? Are you an LLC? Are you a corporation? And then it's a matter of what does the buyer want? Do they want or need a partnership or an S corporation? It comes down to the buyers, why it makes a difference for them. They may or may not be able to be an S corp shareholder. There's requirements for that. They may not meet those requirements. If you're an S corp, that might be a problem. Conversely, a partnership, maybe they need you to be a corporation for one reason or another. So, one, obviously, it's important to know what you are currently. Second, it's important to know what your buyers would need you to be. And so, some of this planning can take a long time. It can't happen overnight. And so, while you may not know your buyer, it's important to know what type of buyer you may be interested in. Do you think a private equity company is going to be interested in your firm and come and buy you and give you an offer? Do you think it's going to be your competitor? Do you think it's going to be your employees? You need to, it's helpful, maybe not need to, but it is helpful to know the type of buyer that might be interested in your company. That way you can start some of this planning ahead of time, or at least convey that to your professional team so they can check what structure you are currently and make changes as needed. Part of the structuring and the deal, we talked about having an asset sale or actually we talked about the point that the buyer and seller want opposing um, types of deals. One wants a stock or partnership interest and the other one wants to buy the assets. We do have some tools, some elections to get around that problem where it can be a stock sale but treated as an asset sale. So there are options out there. That's the elections you see there. And there's also a F reorg if none of those options work. I mean, we have that as a tool. A point of that is we have a lot of tools. All of the are tools available to us. All of these tools, again, the goal is to get this sale taxed at capital gain rates instead of just as a straight fixed asset purchase.
Mhm. And Jeff, I'd like to add to the audience, the reason a lot of buyers don't want to buy stock is because they don't want that liability that is associated with that acquisition. You know, this if you're buying stock, you're assuming the liability of that entity.
That's absolutely right. We don't see that a lot, hardly ever, but um, because of that reason.
Hmm.
So, but again, for the seller, that means they're going to be taxed at ordinary rates
Yeah.
For the fixed assets. So, potentially could be taxed at ordinary rates. So, um, that's why the seller would want that, but the buyer, yeah, certainly does not want to buy the stock or the partnership interest.
But where they have to buy stock is if there are contracts in place that it just then it's an easier transition. So yeah.
Yeah. Yeah, there's more work we have to do if there is restrictions, licenses, contracts in place, um, in order to keep that, or at least be aware of what restrictions we may have of assigning contracts if the entity does change. As we look at the types of entities, if we do have to change from one to another, often that is included in the offer, the additional cost. So if the buyer needs you to be an S corp or a partnership and you're the other, that can be worked into the sales price so that the seller is willing to take on those additional costs. And again, the buyer is interested in paying that because they want to buy your company. They want the deal to go through. And so they might be willing to include that as part of their negotiation if that means you're going to have as the seller additional cost um, to make that happen. So purchase price allocation, this is um, a big part of the transaction, and this has to do with allocating the purchase price to the assets or the items that the buyer is purchasing. And so, we talked about it's great to have the buyer buy the partnership interest or the stock. We talked about it's not really going to happen because they want to buy the assets because they don't want the liability. And so if they're buying the assets, then now they need to assign a price to each asset. And then anything over and above the value, the fair market value of those assets goes to goodwill. Goodwill is a capital gain, meaning the what's allocated to goodwill would be a capital gain. So, we started this conversation that you want everything you really want, a stock or um, partnership interest to be purchased. We've mentioned it probably won't happen. It will probably be fixed assets. That doesn't mean that's a bad deal for the seller because if they don't have assets that have appreciated in value or are significant in relation to the fair market value of the company, that means there's a lot of goodwill sitting there. Anything allocated to goodwill, we're back to capital gains. So if it's a fixed asset sale and through the purchase price allocation, if we determine, hey, all of this is going to be allocated to goodwill or another intangible customer list, that is treated as capital gains. So it might be fine for it to be a fixed asset sale. But it's important to at least understand this in the beginning, because if we do find um, that the purchase price um, doesn't generate, trigger capital gains, we're going to have to relook at this because then the tax burden just increased for the seller. Certainly, this comes through in our tax projections. It's important that we do that very early in the transaction, so we can, give input before it's too late. We have a lot of examples. I have a lot of examples going through, you know, over the years of when agreements or allocations would not have been good, or would have been a negative impact on the seller. I had looked at one a while back that allocated. They had a lot of fixed assets. It was a capital intensive company, but they added a pretty high purchase price to the fixed assets, probably more than it should have. Um, and it was, like $800,000 to fixed assets, and I think they said 200,000 to goodwill. And it was a installment sale. And what that means is we're going to recognize the 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 cost, the gross profit, as money comes in the doors, but we don't get it on day one. A lot of these transactions do involve a installment sale of some kind. And so because we had such a high amount allocated to fixed assets, and all those assets have been written off, we have what's called recapture ordinary income triggered by the sale of those fixed assets, and that's due in year one. And so just looking at the agreement, I had to go back to the client and said, if this is true or if it's not true, you need to reconsider how much you're allocating to fixed assets, because this is going to be your tax hit in year one, whether or not you collect any money up front. And unfortunately, he did not collect any money up front. He was going to start collecting in year two. And so they very quickly renegotiated how much they were allocating to fixed assets and how much they were allocating to goodwill. That could, one, be a lower tax rate, and two, deferred until the years that they actually received the money. So again, it's very important to get us involved early on. Very important to look at projections on how much this transaction is going to cost the seller. Fees for all this, um, it depends on the size of the transaction. I mean, and they can be significant. We need accountants. We need um, advisors like Nora and Chris to help with this. Attorneys. A lot of people are going to be in the room working on your side, and then there's a cost associated with that. When you look at selling real estate, you're probably used to buying or paying 3, 5, 6% in a realtor's commission. Our fees are not going to be that much, but it is a fair comparison that there is going to be cost associated with the deal to make sure that you save on taxes and that you get the best deal that you can for selling, the company that you've worked so hard to build. So you want to get us involved as early as possible.
And Jeff, I do have sort of a question. Does 83B election and qualified small business stock help with some taxes?
I'm sorry, what was the second part?
The qualified small business stock.
Mm-hmm. Yeah, the qualified small business stock is a tool available if we're like a C corp. That if And again, it goes back to that planning, meaning because there's criteria that need to be met in order for um, in order to use the qualified small business stock. You got to hold it for 5 years. It's got to be a C corp, and it's got to be under the fair market value of that company has to be under a threshold. I think it's 50 million. Um, and so if you check all those boxes, then not only do you Well, it becomes a reduced tax or eliminated if you meet those qualifications. When you sell that stock and have the capital gains, it can either be eliminated or reduced if it met those qualifications. So that's a big tool for the the seller when that time comes, if they planned ahead enough time to meet those qualifications. But it's a great tool out there. There's a lot of good tools out there, again,
Mhm.
if you can plan ahead of time. And again, that's why I say it's important to know the the buyer, where the company is going. Because I am in the process of working on another one that is qualified small business stock, and they did this obviously 5 and more years ago, knowing their buyer was going to be, I believe it was private equity, and they were structuring this so that the investors, the early investors, could buy the stock, put the money in, and then I think there was either private equity or maybe they're going public, so that the stock, when they ultimately would sell at the um, action, meaning the eventual sale of the company, they could meet the small qualified small business exclusion and save some money.
Hmm.
Speaking of saving money, we have some changes in the tax bill. The big, beautiful bill that we passed in July. I'm going to kind of speed through some of these slides because they're not directly related to um, the sale or M&A per se, but what will happen is you're going to get a lot of money, a big gain from the sale of your company, and now you got to figure out what you're going to how are you going to deal with that gain. And so it's a few things that we have back now in play is bonus depreciation. That will help if, again, it's a fixed asset sale and the buyer can use this accelerated depreciation. We have that back now. R&D expensing is back, which is a big bonus for businesses. Again, that it might be a new buyer who's not familiar with the company or some of these tax benefits. So if they're not, they need to be aware of, these tools that can help them save money going forward. We talked about qualified small business stock. It does take some, planning, but again, you can see with the holding periods, we have 50% exclusion, 75, 100% if you hit 5 years. We do have higher capital gain limits, meaning your capital gain that you are um, excluding can be up to 10, actually up to 15 million now. It used to be 10. Okay, and now we actually do have a higher asset threshold. I said 50 million earlier. It's actually increased to 75 now. Salt limitations. Um, we have a continuation of that. It has increased to 40,000 from 10 for some taxpayers. The limits are on the slides there, so I won't spend a lot of time reading through that. But we do have the ability to deduct your state and local income taxes again, once again, and it's actually a higher amount now. The other thing, or the last thing that we had coming out of the big beautiful bill is opportunity zones are back. They were set to expire at the end of 2025, but it is a tool where if again you get the money from the sale of your company and you're one of those who didn't want it or didn't need it, doesn't want to pay income taxes on it, you can reinvest those proceeds, that gain, into a qualified opportunity zone and pay it later. It's a deferral, but it's still a good tool if again you're in a sale transaction. You don't know what to do with the gains, meaning you don't really want the gains and you prefer to delay the tax payment as long as you can. That is the end of our tax portion of the M&A webinar. I think that we will open it up for questions now, if we have any. Cami?
So I think we had one, do we help with reaching out to potential buyers? And I'm going to give that to Chris because our firm is very focused on identifying potential buyers. Go ahead, Chris.
Yeah, certainly. So we often have multiple conversations a week with a lot of the financial buyers that we talk to. They constantly want updates on what businesses we currently have for sale, and we also question them on what are they looking forward to? What are they targeting in the market right now? So we're constantly in communication with professional buyers and gauging their interest both on what we have to offer immediately and what they're looking for in the future.
And we have a designated team in our company that's all they do. They take a seller's profile and we go out and actually identify who would be that one company, that one buyer that would benefit the most from making that acquisition, whether it's a private equity firm, whether it's a strategic acquirer, or sometimes a very high net worth individual. We also have a question. As an S corp, can you still get a tax exclusion, or should you convert to a C corp first? And if so, how long do you need to be a C corp before initiating a sale? So that's for you, Jeff.
Yeah, that qualified small business stock is for a C corp. So that is one of the restrictions, potentially one of the issues, um, that you do need to be a C corp. And so, and to get the exclusion, I think it was on 2 slides ago, so I can slide back to it. To get to the exclusions, you got to hold it for that time period, 3 years, 4 years, 5 years. If you don't meet that holding period, you don't get the exclusion. So if that's a tool that you want to use, it does take, some planning. You got to do the conversion and from S to C, and then you have to have the holding period, or meet the holding period. And it's a good question, because once you do the conversion from C to us. You might be a C already and think, hey, it's better because it is, to convert to an S and then do a sale. But the issue with that is you have a holding period where called the built-in gains tax that you're still going to be subject to the C Corp taxes if you don't meet that holding period, from going from a C to an S. You can't go from a C to an S and then sell the next day and expect not to be taxed twice on the gains. There's a holding period. So if you went from a C to an S, you got to meet the holding period to avoid being taxed twice. If you go from an S to a C, there's also a holding period if you want to meet that small qualified small business stock exclusion.
Thank you, Jeff. And we did get one other question. Do we have a questionnaire or checklist that we provide to potential clients that are contemplating a sale to attract investors that can be filled out to see where the gaps are and how much work is needed to prep the company to get the best possible value? Um, as an offer to all attendees, if you're in that camp where you're contemplating an exit in the next 1 to 5 years, one of the things that we do at Plethora is do a complimentary evaluation of your business. We help you identify those gaps. We look at the market where you are today, and we help you look at your projections, and give you a base value. And that is usually a great tool to take to your CPA and sit down and say, okay, where else can I make some improvements, including getting prepped with reviewed financials, which goes a long way, or, ideally audited financials. But so, Ron Capranos, that offer is available to you. And I think that was it
I
as far
think
as
we got a
questions.
new one on. Someone just put in for is reps and warranty insurance required? If so, who pays for it? Can the new merged entity pay for it? They're and then they're assuming that this is part of the negotiation.
Leading to the M&A. Go for it, Chris.
Yes. So is reps and warranty insurance required? No, it is not. If you do not want the reps and warranty insurance, typically what we see is a larger holdback. So instead, with the reps and warranty, you may get 2 or 3% holdback. Without reps and warranty insurance, it could potentially be up to 10 to 20% of the value of the deal that's held back for potentially 1 year, 1 full year. So it would be at that point up to you on how comfortable you were with it. As for who pays for it, entirely negotiated. Sometimes we see the buyer pay for it 100%, but in my personal experience, most of the times it ends up being about a 50-50.
Yeah. And I think to wrap up our session, I can answer. We have a question. How early do we market our company? One of the things that we are seeing in the marketplace, especially in the last 12, 24 months, is that deals are taking longer in the market, especially if you're one of those companies where you're not standing out, you're not that unicorn, you're not that diamond in the rough. Plan on a 6 months minimum, an average 12 to 18 months. Right, Chris? If we look at our data points, from engagement to actual successful exit, it ranges between 8 months and a year and a half.
Correct. That's typically what we're seeing right now.
And to those individuals that that we didn't answer your question, we'll go ahead and answer those post presentation and in an effort to make sure we keep to our timeline.
Yes, thank you, everyone. If we didn't get to your question, we will be sending out an email later today with the recording and the slides with all of the contact information as well. So thank you, everyone, for attending. We really appreciate you being here. Have a great
Thank
day.
you. Thank you. Thank you, Jeff. Thank you, Chris.
Thank you.
Thank you, everyone.
Bye-bye.
Bye-bye.